That was the President of the United States following a payrolls report a little bit earlier this morning. From New York, Bloomberg Real Yield starts right now. Coming up, the jobs report delivering another big miss. Economists believe the Fed will still begin tapering as investors worry about higher prices hurting growth. We begin with the big issue. Just how low is the bar for tapering?
That test has been met.
The kind of disappointing payrolls report.
I don't think this would deter the Fed at all.
It doesn't change much.
The message from the market to the Fed is go ahead and taper.
They've told us they'll start in November.
We're still squarely on track for the Fed to taper.
Something with a plus sign in front of it.
Anything above zero, the Fed's going to taper.
The details, in my opinion, were a lot more constructive than the headline.
Folks who are saying, oh, maybe taper is going to be pushed off are really missing the big picture.
This is really about, the message we got in September from the FOMC.
It's a really low bar here for the Fed.
It keeps the Fed taper very much on the table.
Joining us now is JPMorgan's Bob Michele, BlackRock's Bob Miller, and Winnie Cisar of Creditsights. So let's begin with you, Winnie. Does this meet Chairman Powell's definition of reasonably good, 194,000?
Well, I can't speak for Chairman Powell, but it meets my definition of reasonably good. Clearly, consensus was way off on this one, and I think that the bigger picture is really COVID and pandemic-related disruptions are going to continue to make the economic data really, really noisy. And so we have to continue to look at the longer-term trends and some of the details within the top headline number. And I think for me and likely for the Fed, the taper is still likely going to be on for November announcement.
Bob Michele, this was the quote from Chairman Powell. It wouldn't take a knockout great super strong employment report. It would take a reasonably good employment report for me to feel like that test is met. Is that test met?
Oh, for sure, that test is met. And I think this employment report confirms everything else that we've seen in the economy. If you want something, it's going to cost more. It doesn't matter if it's goods or services, or if you wanted a job, then your employer is going to pay you more to get you to come back to work. I think the other thing that didn't get enough airtime is the survey was only 1 week after the enhanced unemployment benefits expired. Let's see what happens in the coming months.
We can give it some airtime right now. Are you saying, Bob, supply is going to heal a little bit more?
Oh, absolutely. As I said, when you look at the enhanced unemployment benefits, they expired 1 week before this survey. When we look at the Chase data, we see every level of income category at a very high level of savings and deposit balances. Households can still live off of that for a couple more months.
Bob Miller, is the Fed going to be comfortable looking through this one, November 3rd, taper onwards?
Yeah, I think so, Jonathan. Thanks for the opportunity to be here. Always good to be with you. I can't disagree with anything my colleagues have said, nor the series of comments offered at the beginning of the session. It's sufficient. You know our view. We think the Fed should have started tapering months ago, like 6 months ago, upon the introduction of a very, very effective vaccine. But can I get to a point that I think is really relevant?
Please do.
And isn't discussed a whole bunch around this taper idea? This taper is going to be really different than prior tapers. So consider the following. At the same time, assuming the Fed starts reducing its asset purchase program in, let's say they announce it in November and they start in December. At the same time, at the November refunding, the Treasury is going to announce a fairly large reduction in coupon issuance over the next 2 to 3 quarters, because at the current run rate of monthly auctions, the Treasury would be overfunded over the next couple of years. So those two things are actually going to sequence really well together. So typically in a tapering scenario where the Fed is reducing asset purchases, it's forcing the private sector to absorb more of the issuance. Theoretically, yields go up to accommodate that increased need for demand from the private sector. This time around, Treasury issuance on a 10-year note equivalent basis, so DV01 adjusted, is actually going to decline in step slightly more than our expectation for the pace of tapering from the Fed. So there's going to be no disruptive rise or tightening in financial conditions due to tapering this time around. I think it's going to be a non-event.
So you think the effect will be neutralized on the bond market, Bob? Is that what you're saying?
from a duration standpoint, the Treasury reductions in coupon issuance that we expect, that are similar to what the Treasury Borrowing Advisory Committee published in its most recent report at the August refunding, are largely going to offset, if not slightly more than offset, the duration impact of fewer Fed purchases.
Really, really important point that we'll build on. Bob Michele, Bob Miller, Winnie Cisar sticking with us. Coming up on the programme, your auction block. The auction block, including a surge in energy debt coming to market as energy itself surges. That's next. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe with a multi-tranche offering from Thermo Fisher leading the way, helping issuers across all sectors raise more than 30 billion euros this week. Sales of US investment-grade bonds topping forecast this week. 8 borrowers issuing debt on Thursday alone, fueling weekly volume past 27 billion. And junk bond sales getting a big boost from energy companies this week, rushing to market, capitalising on surging crude prices and robust demand. Back with us, Bob Michele, Bob Miller, and Winnie Cisar. Winnie, straight to you. Walk me through where you think this taper story is going to hit this market. Bob Miller going through things, saying that maybe we neutralise the impact on the Treasury market at least. What are your thoughts on that?
I think his point on the Treasury market impact being neutralized is really important. But I also think that you have to take a step back and think, okay, what else is available in the broader universe of fixed income? Because despite the fact that there might be a little bit of give and take and neutralization in the Treasury market, I do think that we're going to continue to see very robust corporate credit issuance and also just issuance across the board of fixed income, so long as yields stay really within the ballpark. They can go up a bit and still be a very compelling place for issuers to be borrowing capital. So if we start to see more of these moving pieces where perhaps we have a Fed taper and an accelerating or at least very steady issuance in corporate credit, but then investors are saying, hey, the Fed's tapering, inflation is game on, I need to be in equities, I need to be in loans, I need to be in something that has some sort of inflationary protection and upside, then that demand picture starts to really get a little bit more skewed. And one of the things that we saw this past week is a pretty hefty outflow from US IG and high yield. And the IG one is a little bit disconcerting because you did see capital instead going to those inflation-linked products. And so for fixed income, while the Fed taper might be kind of a non-event, the shift in demand and allocation of capital could be a pretty significant event.
Bob Michele, can you build on that for us? We all agree, you all agree, that the jobs report today keeps the light green for the Federal Reserve. Let's talk about what it means for this market. What does it mean?
Well, it means that the Fed will taper. It means by the middle of next year, they should be down to zero net purchases on a monthly basis. It also means something very important. I think many people in the markets are under the illusion that bond investors set the price of debt. We don't. The central banks are doing that right now. And to return to normal, for me, normal means that they get the heck out of our markets and we're free to set the cost of financing in the bond market. And right now, that's not happening. If it were happening, if I were setting the price of financing in the bond market, it would be a lot higher than it is now. And of course, that would push up the cost of companies to borrow as well. Corporate America right now is borrowing at a negative real yield. That's unsustainable.
Well, let's talk about how sustainable or unsustainable it is. We have these big conversations about normal. I've got no idea what normal is. We've been doing this now for more than a decade. I've got no idea what's sustainable or not either. I'm looking at some of the rate cuts and rate hikes we've had. Rate cuts since Lehman. This from Bank of America. This stat just blew me away. 999 global rate cuts since Lehman, according to Bank of America. 56 rate hikes year to date, the most since 2011. Now, Bob Miller, when we talk about the end of easy money, what are we talking about here? What's normal? The last 10 years? The 10, 15, 20 years before that? What is normal?
Oh, Jonathan, I think the predecessor Bob was correct that let me rephrase the signal value of sovereign bond market prices relative to macro inputs has been totally suffocated by central bank intervention in developed markets over the past decade plus, and I don't think that's going to change anytime soon. So this, that we like to talk about the bond market vigilantes. Well, it's not that they don't exist. It's that they're simply not large enough relative to the size of what we consider the non-economic participants that are so large in the bond market. Central banks, foreign central banks who hold dollars as reserves, commercial banks who have massive regulatory pressures to hold high-quality liquid assets, et cetera. It's another way of saying that the Vikings won't be coming ashore to pillage the bond market anytime soon. I don't think we're going to get out of this regime for a very long time.
Well, this has huge ramifications, implications for this market. Bob, ultimately, what really matters then is if this Federal Reserve has to step away, even if it does not want to step away, if they'd be forced to. Bridgewater brought this up earlier this year, and I think it's a really compelling thing to talk about. We've got used to a world where central banks and policymakers get what they want, that they can stay around for as long as they want because they have time on their side. Do they have this luxury this time around? Do you see things changing somewhat, Bob Michele?
Well, certainly it appears that they can stay around as long as they like because no pain has been created. There doesn't seem to be anything that's gone wrong. It's as though the era of MMT works perfectly. Of course, we haven't gotten to the point where asset prices look pretty inflated, and we haven't gotten to the point where we have to figure out who's going to pay back all this borrowing that's accrued over the last 18 months. I think when we start to focus in on those two problems and come up with answers to those questions, then the central banks will hasten for the exit.
I'm trying to understand, though, from your perspective, whether you've changed anything when it comes to credit. Winnie's laid out how she'd play things. Bob Michele, are you still long corporate credit, high yield, all of that good stuff? Just give me an idea of how constructive you are on credit at the moment.
I love corporate credit. I think it's unambiguous. Corporate profitability is very high. I know there are input cost increases. Some of those will be absorbed in margins. Some of those will be passed through. Final aggregate demand isn't going anywhere anytime soon. So companies do have the ability to pass that through. Corporate America, corporate Europe are funding themselves largely at a negative real yield. And oh, by the way, there's so much money that's in the private markets now, they're waiting for an industry or a company to go through restructuring so they can step in. So recovery values are coming out at 100 cents on the dollar. That's a golden era for investing in corporates. And yes, I'd love to buy high yield at 8%, but it's not going to be there for quite some time yet.
Winnie, is it a golden era?
I would say it's a golden era in terms of fundamentals. Absolutely. All of those things that Bob just highlighted are spectacular. But does that come at the expense of the bondholder long term? If we have ultra low borrowing costs, borrowing at negative real yields, does that mean that we're going to just start borrowing and pay back our equity holders, do a lot of stock buybacks, pay a lot of dividends, maybe some take private transactions, all at kind of the degradation of corporate credit metrics? And at 2% in IG and low 4% in high yield, it doesn't feel like a compelling pound the table. Now, you can't argue with the cash on the sidelines. That is an absolute reality. And corporate credit is right now a very significant cash proxy for a lot of investors. And in that scheme, I much prefer high yield to investment grade, at least that there I'm getting some yield for any sort of credit risk that I'm taking, albeit very low right now, which is something that I do agree with Bob with.
Winnie Cisar alongside Bob Michele. Bob Miller sticking with us, still ahead, the final spread, the week ahead, featuring the Fed minutes and another important inflation print in America. From New York, that conversation's next. This is Bloomberg. From New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, U.S. bond markets closing on Monday for the Columbus Day holiday. Fed officials speaking throughout the week with Evans, Bostic and Brainerd all on the calendar. The FOMC minutes and U.S. CPI coming up on Wednesday, and rounding out the week with U.S. retail sales on Friday. Back with us for some final thoughts, Bob Michele, Bob Miller, Winnie Cisar. Let's get to the rapid fire round, guys. 3 quick questions, 3 quick answers, and start with this 10-year yield. Right now, 160. Yields higher as I see them, up 3 basis points. The high of the year, late March, the end of Q1, 177. Can tens take out the high of the year before year end? A yes or a no? Bob Michele.
Yes.
Bob Miller.
Yes.
Winnie Cisar.
Nope.
Yes, yes, and a no. Next question. Is the light still green for tapering? I've got a good idea from you all on whether that is still on. Is the light still green for tapering? Yes or no, Winnie?
Absolutely yes.
Bob Miller.
Yes.
Bob Michele.
The field's been tilted too long to borrowers. It's time to tilt it back to savers. Tapering starts.
There we go. That sounded like a speech, Bob Michele. Let me just give you the third and final question. Supply side issues, we talk about them all the time. They're well known, they're well discussed. I'm trying to understand whether they're peaking. So just give me a feel for things from your perspective. Do you think supply side issues have peaked yet? Bob Michele.
No.
Winnie Cisar.
No.
Bob Miller.
No, I don't. I think we're 2 to 3 quarters away from where we see a genuine deceleration in supply side constraints.
Wow, we're going to be talking about this for a while then. Bob Miller, Bob Michele, Winnie Cisar. Guys, thank you so much. After that downside surprise on a payrolls report, the light, according to many of you, is still green for tapering on November 3rd. This bond market's selling off from New York. This was Bloomberg Real Yield. I'll see you next week, same time, same place. This is Bloomberg TV.